There's a moment in every market cycle, and I mean every single one across hundreds of years of financial history, where the window to act is open. The opportunity is sitting right there in plain sight, and the vast majority of people walk right past it. They walk past it because it doesn't feel urgent. It doesn't feel like anything special is happening. The news isn't screaming about it. Your neighbor isn't calling you at midnight. And so they wait. They wait until everyone is talking about it, until the price has already moved so far that even your dentist and your brother-in-law are bragging about what they bought. And by then, by the time it feels safe and obvious and confirmed, the window is already closed. I'm going to make a very direct argument today, and I want you to hear me out completely. Because what I'm about to walk you through is not a guess, not a hunch, not some YouTube influencer prediction. This is a structural analysis of a supply and demand imbalance that has been quietly building for years, and the data is pointing in one direction. The window to buy silver at these levels, and I mean cheap silver, historically cheap silver relative to what's coming, that window is closing. And once it closes, it may never open again in our lifetimes. Let me tell you what I mean by that. Right now, silver is trading in the mid to high $60 range per ounce. That sounds expensive compared to where it was 5 or 10 years ago. But here's the thing, context is everything in markets. A few months back, silver touched over $120 an ounce. It was one of the most violent, breathtaking moves in precious metals in modern memory. And then it pulled back. Markets do that. Momentum runs hot, profit-taking kicks in, weak hands sell, and prices correct. That pullback, the one that's happening right now, is not a sign that the bull run is over. It's the breath before the sprint. And if you understand why silver went to those levels in the first place, you understand why this current price level is the opportunity that most people are going to miss entirely. Before we go any further, if you want to skip the research phase and go straight to protecting your wealth, check the description below. There's a free guide I put together that covers the saving strategies that thousands of American retirees are using right now to shield their hard-earned money from what's coming. It's completely free, it's in the description, take a look when you're done here. Now, let's talk about what's really happening with silver, because almost nobody is explaining this properly. There is a global silver deficit that has now persisted for 6 consecutive years. 6 years in a row, the world has consumed more silver than it has produced. We are not talking about a rounding error. We are not talking about a few million ounces here and there. The Silver Institute, which is the most authoritative body tracking global silver flows, has documented a projected deficit of 65 to 70 million ounces this year alone. Total global supply is expected to reach around 1,050 million ounces at its decade high, even with mine production ticking slightly upward. But demand is running between 1,070 to 1,090 million ounces, and mine production, despite years of elevated prices, is only increasing by about 1%. 1%. You cannot meaningfully grow silver production in a year. You cannot wave a magic wand and open new mines. It takes 7 to 12 years to bring a world-class silver mine from discovery to production. That pipeline does not exist to fill the growing gap. The cumulative drawdown on above-ground silver stockpiles since this deficit cycle began has reached over 760 million troy ounces. That number is staggering. Think of it this way. The world is eating into its silver savings account at a rate that cannot continue indefinitely. And the people running the numbers at the world's largest financial institutions know this. JP Morgan, the largest custodian of silver in the world and one of the most sophisticated commodity desks on the planet, has stated that silver prices could average over $80 an ounce in coming periods, describing the physical deficit as potentially escalating to a scale we have not seen in the modern era of commodities trading. When JP Morgan makes that call, you pay attention. But let me go deeper than the headline numbers, because this is where the story gets truly fascinating and a little terrifying if you understand the mechanics. Silver is not just money. It was money for thousands of years. Yes, every major civilization, from ancient Rome to imperial China, used silver as its primary medium of exchange. But silver today has a dual role that no other asset in the world has. And that dual role is what makes the supply math so explosive. Silver is simultaneously a monetary metal and the most industrially critical element on the periodic table for the technologies that are defining the 21st century. Every single solar panel requires silver. The photovoltaic cells that convert sunlight into electricity are coated in silver paste. There is no viable substitute that comes close to silver's conductivity at an industrial scale. The explosive growth of solar energy installations across the globe, China alone is building solar infrastructure at a rate that would have been science fiction a decade ago, is consuming silver at a pace that is simply not reflected in the price. The green energy transition that governments around the world have committed hundreds of billions of dollars to is, at its physical foundation, a silver consumption program. Then add electric vehicles. The average electric vehicle contains significantly more silver than a traditional combustion engine vehicle. Every EV uses silver in its circuit boards, its battery management systems, its charging infrastructure, its sensors. As EV penetration rates climb globally, as charging networks expand, as the semiconductor content of every automobile increases, every single one of those units is a silver-consuming machine. Then there's the semiconductor industry, which is essentially the backbone of the entire modern economy. Artificial intelligence infrastructure requires enormous amounts of silver. The advanced chips that power data centers, that run the models that everyone is talking about, that process the transactions and information of a digital civilization, silver is embedded in their production at every level. Here is the brutal economic reality. The industries consuming silver in these applications cannot reduce that consumption. If you're building a solar plant, you are not going to stop building it because silver went up. If you're manufacturing semiconductors, you are not going to find a cheaper substitute that performs equivalently. The industrial demand for silver is what economists call inelastic. It does not respond the way typical commodity demand responds to price increases. It gets consumed because it must be consumed. And unlike gold, which is essentially hoarded, 90% of all gold ever mined in human history still exists in vaults and jewelry. Silver is used up. It's consumed in industrial processes in quantities too small to economically recycle. It goes into products that end up in landfills. It disappears. Above-ground stockpiles that were once enormous, the kinds of stockpiles that governments held throughout the 20th century, have been drawn down dramatically. The United States, which once held billions of ounces of silver in strategic reserves, has essentially depleted those reserves. The same story has played out across Western economies. Now, let me take you back in time for a moment, because history has a lot to teach us about what happens when silver's supply and demand dynamics get severely out of whack. The 1970s are the reference point that most serious precious metals analysts return to. In 1971, President Nixon did something that changed the financial world permanently. He severed the link between the US dollar and gold, ending the Bretton Woods system and creating for the first time in modern history a world of pure fiat currencies, currencies backed by nothing but the promise of governments. The monetary architects at the time called it a temporary measure. That temporary measure is now over 50 years old. And in the decade that followed 1971, as inflation ran hot and the dollar's purchasing power eroded dramatically, both gold and silver went on absolutely historic runs. Silver went from under $2 an ounce to nearly $50 an ounce by 1980. That is a more than 20 times move in less than a decade. Now, history doesn't repeat exactly, but the structural conditions that drove that move, dollar debasement, loss of confidence in monetary systems, geopolitical upheaval, supply constraints, those conditions are present today in a form that many analysts argue is actually more extreme than anything we saw in the 1970s. Consider what central banks are doing globally. In the first quarter of this year alone, central banks purchased 244 tons of gold, a 17% increase from the prior quarter. In 2025, global central bank gold purchases reached 863 tons, nearly double the pre-2022 average. Poland, Uzbekistan, China, Indonesia, Guatemala, Malaysia, country after country that once held the majority of their reserves in US dollar-denominated assets is quietly, systematically, deliberately shifting toward gold. The World Gold Council found that 70% of central banks surveyed plan to increase their gold reserves, not maintain them, increase them. Why does this matter for silver? Because when institutions and sovereign nations start fleeing paper assets in favor of hard money, and that is exactly what gold represents, the dynamic that drives gold higher also eventually drives silver higher. Historically, the ratio between gold and silver prices, how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 40 to 60 to 1 over long historical periods. Right now, with gold near $4,300 and silver in the high 60s, the ratio is deeply historically elevated. That ratio doesn't stay out of whack forever. When it reversion trades back toward historical norms, the silver price move required to close that gap is dramatic. And this brings me to something that very few retail investors understand: the mechanics of the paper silver market, and why COMEX, the primary futures exchange where silver is traded, represents both a risk and a catalyst that could accelerate everything I've just described. The COMEX silver market trades what are called futures contracts, paper promises to deliver silver at a future date. The volume of silver that changes hands on the COMEX on any given day dwarfs the amount of physical silver that actually exists in deliverable form. For years, this system worked because the vast majority of traders had no intention of taking physical delivery. They were just trading pieces of paper that tracked the silver price. But something has changed. The percentage of traders demanding actual physical delivery has been rising dramatically. And when you compare the outstanding contracts against the registered silver actually available for delivery, you start to see a gap that makes financial regulators nervous. Think about what happens if even a fraction of paper silver holders demand physical delivery at the same time. The exchange would face a crisis of non-delivery, a force majeure declaration, a settlement in cash at a price set by the exchange rather than by the market. This is not a hypothetical. There are documented cases in commodity markets where paper and physical have decoupled violently when delivery stress hits. And the conditions for exactly that scenario in silver are more present today than at any point in the modern era. China adds another layer of complexity to this picture. China controls approximately 70% of the world's refined silver output. China has been restricting silver exports, redirecting domestic silver supply toward its own manufacturing base, its solar panel factories, its EV production lines, its semiconductor fabrication plants. When the world's dominant silver refiner starts ring-fencing its own supply, the global market for physical silver gets tighter in ways that futures prices do not immediately reflect. European banking regulations, the Basel III framework, are now compelling European banks to secure physical precious metals to back their derivatives positions in ways they previously didn't have to. This is institutional demand for physical silver that is regulatory in origin, meaning it is not optional. Banks cannot choose to ignore it. They must acquire physical metal to comply. You take the structural supply deficit, 6 consecutive years and counting. You take the irreplaceable industrial demand from solar, EVs, and semiconductors. You take the paper-to-physical stress building in the COMEX system. You take China restricting exports. You take Basel III regulatory demand from European banks. You take de-dollarization and central bank gold buying hammering the investment case for hard assets broadly. You take a gold-to-silver ratio that is historically extreme and mathematically due for compression. And then you look at silver sitting where it is today, having pulled back significantly from its recent highs, and you start to understand what the window closing actually means. It doesn't mean silver goes up tomorrow. Markets are never that clean. But the forces that are going to push silver dramatically higher over the medium term are structural. They are accelerating, and they are not reversible on any timeline that matters for planning purposes. Now, I want to take a brief moment here because I think about the people watching this channel, and I know a lot of you are in or approaching retirement. You've worked your entire life to build what you have. You've played by the rules, you've saved, and right now, the financial system you trusted to preserve that wealth is under stresses that most mainstream financial media is not explaining to you clearly. The erosion of purchasing power through monetary inflation, the geopolitical fragmentation that is reshuffling global trade and dollar dominance, the debt levels that have reached historic extremes in virtually every major economy. These are not abstract concerns for future generations. They are wealth-eroding forces that are active right now. This is why I'd encourage you, particularly if you have $100,000 or more sitting in a retirement account, to look into a gold IRA. A properly structured gold IRA allows you to hold physical precious metals inside your tax-advantaged retirement accounts, using the same tax protections you already have, without any penalties. It's a way to get actual physical gold or silver working inside the accounts you've already built. The guide in the description covers this in much more detail. It's free, there's no obligation, and it gives you the information to make a decision on your own terms. The hedge isn't for everyone, but if you've watched this far, you already understand that something is shifting in the global financial order, and diversifying into hard assets is what the world's most sophisticated institutions are doing right now. Let me come back to the historical picture for a moment, because there's another chapter of history that I think is enormously relevant and almost nobody talks about anymore. In the early 2000s, silver was trading below $5 an ounce. If you go back even further, to the depths of the 1990s commodity bear market, silver touched below $4. At those prices, silver was dismissed. It was a byproduct metal, mostly a waste product from mining other things like copper and lead and zinc. The industrial applications that exist today barely existed. The investment case was thin. Retail investors had largely forgotten that silver had ever been money. And then, slowly at first, then all at once, everything changed. The internet economy created semiconductor demand. The green energy movement created solar demand. Emerging market industrialization created electronics demand. And the investment demand that always accompanies monetary stress started flowing back in as the dot-com collapse and then the 2008 financial crisis reminded people that financial assets can vaporize while hard assets remain. Between that sub-$5 level and silver's peak in 2011, silver moved from under $5 to nearly $50 an ounce, a roughly 10-to-1 move that made people who had quietly bought and held silver look prescient beyond measure. And then it pulled back, as all markets do. It spent years consolidating, frustrating people, making them doubt the thesis. And then the thesis reasserted itself. The pattern is consistent across history. The structural fundamentals build. The price lags. The skeptics declare the thesis dead. The consolidation extends. And then the market catches up to reality all at once, usually in a move so fast that the people who were waiting to confirm the trend miss the majority of it. What's different this time, what makes the current setup more compelling than any previous silver bull cycle I've studied, is the industrial demand dynamic. In past cycles, the investment case for silver was primarily monetary. It was a hedge against dollar debasement, a store of value in uncertain times. The industrial demand was present, but not dominant. Today, the industrial demand is structural and growing, independent of any monetary or investment thesis. Even if you believed that inflation was completely controlled, that geopolitical risks were minimal, that the dollar was perfectly stable, even if you believed all of that, you would still have a silver supply deficit driven purely by solar panels, electric vehicles, and semiconductors. The monetary investment case is an accelerant on top of an already burning industrial fire. And here is what I think is the most important point I can make in this entire video. The people who understand this, the large industrial corporations, the sovereign wealth funds, the mining majors, they are not waiting. They are not watching YouTube videos and debating whether silver is going to be a good investment. They are locking in supply contracts. They are securing physical inventory. They are bidding for projects in the ground years before they produce an ounce. They are acting with urgency because they understand that the window to secure silver at prices that will look absurdly cheap in retrospect is a finite window. The Hunt brothers tried to corner the silver market in 1979 and 1980. They bought contracts aggressively, accumulating positions so large that they drove the price from under $10 to nearly $50 in a matter of months. The story ended badly for them. Regulators changed the rules, margin requirements were raised, and their leveraged positions collapsed. But here's the lesson that almost nobody takes from that story. Two brothers acting alone with borrowed money nearly broke the silver market. What we're looking at today is not two brothers. It is the entire industrial economy of the 21st century structurally consuming silver faster than it can be produced, against a backdrop of monetary stress and institutional demand that dwarfs anything the Hunt brothers attempted. You don't need leverage. You don't need options. You don't need to time this perfectly. What you need to understand is that the structural supply and demand math in silver has one logical resolution, and that resolution is higher prices. Significantly higher prices. Prices that will make the levels we're trading at today look like the generational opportunity that they represent. The people who bought gold in 1971, when Nixon closed the gold window, weren't geniuses. They weren't sophisticated traders with proprietary models and Wall Street access. They were people who understood what was happening to money, who understood that fiat currency divorced from hard assets has a historical tendency to debase, and who acted on that understanding when the price was still accessible. Those people watched gold go from $35 an ounce to $850 an ounce over the following decade. They were not celebrated for their timing. They were celebrated and financially rewarded for their conviction. The window to buy silver at these prices will not be open indefinitely. The deficit is compounding. The above-ground stockpiles are drawing down. The industrial machines consuming silver cannot be switched off. They are solar plants providing power to millions of homes. They are factories producing the semiconductors that the entire global economy runs on. They are the electric vehicles that governments have mandated and consumers are adopting. None of those demand streams are going to stop because silver becomes more expensive. They will simply consume whatever silver exists at whatever price the market requires. What changes when the window closes is not the opportunity to buy silver. You can always buy silver at whatever the market price is. What closes is the opportunity to buy silver at a price that still reflects the old paradigm, the world before the deficit became undeniable, before institutional investors rotated in at scale, before the paper market stress became visible to everyone. The financial system is undergoing the most significant restructuring in at least 50 years. The dollar's role as the uncontested global reserve currency is being questioned by nations representing a majority of the world's population. Central banks that once held U.S. treasuries as their safe haven asset are pivoting to gold at a pace that would have seemed impossible just a decade ago. The green energy transition has created an industrial demand for silver that is permanently embedded in the economy's future. The COMEX delivery mechanics are under a stress that is building toward an inevitable resolution. And above-ground silver stockpiles that were once a comfortable buffer have been drawn down for 6 consecutive years, with no end to the deficit in sight. If you are a retiree, if you have worked your entire life to build wealth that needs to survive the next 20 or 30 years, this is the moment where understanding precious metals matters. This is the moment where asking the right questions about how your retirement savings are protected becomes urgent rather than optional. The guide in the description is a starting point. It's free. It covers the strategies that thousands of American retirees have already used to reposition a portion of their savings into hard assets. Read it. Think about whether it applies to your situation. And if you watched this entire video because you're still here, and that tells me something about how seriously you're taking this, I want to offer you something additional. For people who have watched to the end, who have a minimum of $100,000 in any retirement account, and who want a real conversation about how to protect that wealth in the environment we've just described, there is a free one-on-one educational web conference available. No obligations, no pressure, just an actual conversation about your specific situation. Mention that you watched this video to the end, and that conference is yours at no cost. Details are in the description below. The window is open. The clock on this opportunity is running. The question is whether you act while the price still reflects yesterday's understanding, or wait until the rest of the world catches up and the window is already closed.